participants rolling in as well. So we'll take some time to wait for the rest to join in. Yeah. Hi everyone. Yeah, thanks for joining. We'll wait for the rest to join in before you can officially start. All right, thank you. Hi everyone. Thanks for joining the webinar. We'll wait for the rest and we'll start officially at 7:05 p.m. All right, thank you. Okay, hi everyone. It's 7:05 p.m. and we'll officially start the webinar right now. Okay, so good evening, everyone. Firstly, welcome to our webinar. I am Joseph from Tiger Brokers and will be the host for today. So today we have a special guest with us today, Mr. Ong Xun Xiang, which is the Associate Director, the ETF Business Lead from Lion Global's Investors. So today, he will be sharing with us more about the recent Lion-OCBC APAC Financials Dividend Plus ETF, which is currently open for IOP, initial offering period. So he will be showcasing the ETF key features, financial performance, and outlook. So before we dive in, let's take care of some few let's take care of a few housekeeping items. If you have any questions during the webinar, feel free to type them in the chat box. We'll address them during the Q&A session at the end. Also, make sure your microphone is muted to minimize background noises. Okay, so with that, let's officially start the webinar. So Xun Xiang, whenever you are ready, over to you.
Hey, thank you, Joseph, for the introduction, and good afternoon, everyone. Oh, sorry, good evening, everyone. Okay, let me share screen. All right. Okay. 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 Good evening, everyone. Thank you, Joseph, for introducing me and inviting me here today. I'm Xun Xiang from Lion Global Investors. You can call me LGI's ETF guy. So today I'm here to share with all of you about our new ETF, which is the Lion-OCBC Securities APAC Financials Dividend Plus ETF. If there are two things I want all of you to take away, it'll be two key facts about this ETF. The first would be that this ETF will pay a minimum 5% per annum quarterly distribution. So this is the first point, 5% per annum quarterly distribution. And the other key point would be that this is the world's first APAC Financials ETF. So two key points, minimum 5% per annum quarterly distribution, and also the world's first APAC Financials ETF. And before I dive specifically into the ETF, maybe I'll walk through key introduction and brief introduction about LGI first. So LGI, we are one of Southeast Asia's leading asset managers. We are part of OCBC Group, and today we manage up to 71 billion Sing dollars of assets for our clients. And we started our ETF journey more than 6 years ago when we listed our first ETF, which is the S-Rate ETF, back in 30th of October 2017. And since then, between 2020 to 2022, within 18 months, we listed 3 ETFs during this same period. And this moment actually propelled us forward to become one of SGX's top 5 ETF issuers. And after that, in earlier part of the year, which was around 2 months ago, we listed Singapore's first active ETF. And this was the Lion Nomura Japan Active ETF, powered by AI. So applying the cutoff as at the end of 2023, 3 out of our 4 ETFs actually achieved top returns among their respective segments on the SGX in 2023. For example, our S-Rate ETF was the top performing REIT ETF in 2023. Hang Seng Tech ETF was the top performing China equities ETF on the SGX in 2023. And also our Singapore low carbon ETF was the top performing Singapore equities ETF in 2023. And our ETFs are also within the top 10 ETFs held by retail investors, as you see here. So, for example, Hang Seng Tech ETF and our S-Rate ETF. And if we zoom even further into the SRS segment, what you will notice and see is that our ETFs are also within the top 10 ETFs held by SRS investors. And zooming further into the topic about top 10 ETFs held by based on trading turnover and trading volume, our ETFs are also within the top 10 by trading turnover and trading volume. And special mention would be that for Hang Seng Tech ETF, we were the top traded ETF in 2022 and 2023 for 2 consecutive years. And so with all these happening, are happening, and because Lion Global Investors, we are headquartered within Singapore, we are domiciled in Singapore. And this makes us committed to delivering quality ETF and quality solutions for our clients, for investors within the Singapore ecosystem. And that's what prompted us today to launch our 6th ETF, which is the Lion-OCBC Securities APAC Financials Dividend Plus ETF. So it's our 6th ETF, beyond the 5 ETFs you see earlier. And we decided to focus on the financial sector because the financial sector includes companies that are that provide services and products that focus on the growth, storage, and transaction of money and assets. So it's a plain, traditional, and old sector. But precisely because it's plain, traditional, and old, is where it is an interesting and resilient sector that survived centuries, prospered throughout the centuries. So imagine, right, the financial sector actually first began by barter trade of seashells. For example, this came from African artifacts. Then after that, we started trading yuan bao or gold to barter and get different goods and services. And then after that, we moved on to paper currency. And after that, to credit cards, which you see, and then to mobile banking in terms of where we can pay and transfer money to each other through mobile QR codes. And now on the frontier, we are looking even also at the portion where we are expecting further developments within blockchain and through central bank-backed digital currencies. So all these are important to ensure and help financial sector prosper throughout the centuries. And it's important because the financial sector is an essential capital provider for economies worldwide. And that roots the financial sector in terms of its importance because it is old, it is traditional. And old traditional means actually is good because it is an essential capital provider for economies worldwide. And that is why it has prospered and survived throughout centuries and weathered so many crises. And when we think about the financial sector, it is not just about banks. It is also about investment management, for example, like Lion Global Investors here. Also about insurance, about brokerages, for example, like Tiger Brokers, and also exchanges, which is where we are listing our ETF on the SGX. Because the financial sector is basically an ecosystem that helps to smoothen the flow of capital and investments. And all these are important to enable economies to trade globally. So I've covered why financials. And the next thing would be why APAC Financials. So in terms of why APAC Financials, key thing to note, it is one of the world's most profitable sectors. It has generated more than 12 trillion in terms of revenue globally, and more than half of adults within Asia Pacific are actually underbanked. So this presents a large opportunity set across different regions. So for example, APAC is at 55%. If you compare to world average, is around 50%. So actually with this huge opportunity set you see, APAC Banks and APAC Financials can actually grow even further by serving the underbanked in developing Asian markets. And another key thing and key point about APAC region would be that the APAC savings rate is much higher than the world's average, which is around 25%. But you look at the APAC savings rate at around 29%. And when we zoom in, you'll notice that ASEAN and Singapore are actually the key drivers behind the high savings rate of APAC. And if we look as a whole among the world's top 30 banks by market cap, 13 of them are from APAC. So 13 out of 30 are APAC banks. It's important because APAC's high savings rates help to improve the deposit rates, which deepen the banking deposits and help to ensure greater capital to fuel growth of economies and also help to improve economic resilience within this region. And when we talk about banks, APAC financial sector is a diversified mix, not just of developed sectors and developed markets, but also on developing markets like Indonesia, Malaysia, and Thailand. And APAC banks, for example, like DBS, OCBC, consistently and typically pay high dividends. So this is crucial because after showing a track record of paying consistently high dividends, this sets the foundation for stable dividend income. So key thing, quality banks and stable dividends. And when we talk about the financial sector, remember earlier, I mentioned that it is an ecosystem. So it also includes insurance. And in terms of the insurance sector, the insurance industry within APAC was actually among the world's largest in 2021, with 5 APAC countries among the top 10 global markets by written premiums. Another key fact is that until 2026, the emerging markets within APAC, for example, Indonesia, Thailand, and Malaysia, which are also part of the index universe, are expected to grow at an annual growth rate of around 20% respectively. So it's important because it presents insurance and positions insurance as another high growth segment within the APAC financial sector. So I've covered why financials, why APAC Financials. And if you notice, the name is Lion-OCBC Securities APAC Financials Dividend Plus ETF. So what is actually in the plus? There are three key catalysts within the plus. The first one is about cushion profitability. So key thing, you look at the past few years, especially 2 years, banks have posted decade high profits globally, high ROE also decade. But if you look at the fundamental reason, a lot of it were driven by high interest rates that have powered the improvement in net interest margins. And this has helped to improve the sector's profits. And in 2023, the sector ROE was actually expected to hit 13%. So this is actually at around 50% higher than the 14-year average ROE on 9%. And we are right now expecting more and more anticipation about rate cuts, US rate cuts happening. And in this kind of context, well-capitalized banks are actually more likely to maintain profitability. So I'll repeat again, well-capitalized banks are more likely to maintain profitability. So it's a key point because the ETF basically consists of the top 30 largest and most tradable APAC financials. And these are the banks or the financial institutions that tend to be well-capitalized. And these are the well-capitalized players that are more likely to maintain future profitability. So this is the first point. The second point would be the tilt towards Asia and also the increasing wealth within Asia as a region. So key fact, banks group along the Indian Ocean are already home to half of the world's best performing banks. In the next 10 years, more APAC banks are expected to join the top global 100 banks. Key thing to note, global wealth is already expected to exceed $500 trillion this year. And this is around 5 times of global GDP. And the biggest wealth source expected to come from APAC, which is at around 200 trillion. And this rise within APAC wealth will help to catalyze the growth of APAC financials. So this sums up the second point, the tilt towards Asia and the rise in APAC wealth, which will help to catalyze the growth of APAC financials. And the third point and catalyst would be about the APAC financials pivot towards capital light and digital models. So it's important because capital light models tend to use much less in terms of balance sheet, but actually bring higher in terms of net income and return on equity. So based on the McKinsey study, as you can see here, in the past 6 years, transaction activity actually used 16% of capital. But in the same time, they actually brought 33% in terms of profits. So what you notice here, 16% and then 33%. It's actually like a 2 times multiplier. So if you are a bank or a financial institution, you use less of your balance sheet, but you generate actually 2 times more profit. It's actually much more profitable to be in a capital light model. And precisely because of this, a lot of financial institutions are embracing digital transformation, including AI, big data, to become more capital light. So one example would be DBS, which has specifically mentioned inside their annual report that digital customers are consistently more valuable with an increasing share of income, sustained higher income per customer, better efficiency, and also higher returns. So to sum up, being capital light and going digital actually helps to improve profitability. It's a key point which I will explain later when we talk about the different constituents involved within the ETF. And as we speak, APAC financials are actually still at an attractive entry point right now. So if you compare in terms of the price to earnings ratio, right, the index is trading at 10 in terms of P ratio. But if you compare to the STI, which already has around 50% Singapore banks, the STI is trading at 16 in terms of P ratio. So we are almost like half of STI in terms of PE ratio. And if you compare to the IHS REIT Leaders Index, which tracks the larger and leading S REITs, our P ratio is actually around half of the P ratio for S REIT Leaders Index. So in terms of valuation, it's trading quite cheaply. And if we compare in terms of price to book, it's trading at 1. Price to book for STI, which consists of 50% of the local banks, is at 1.4. But we're still also comparable to the IHS REIT Leaders Index. And the next thing will be the interesting thing. In terms of dividend yield, the index is at 5.9%. So we are actually higher than the STI, which actually is at 5.1% and consists of the 3 local banks. And the 3 local banks already take up around half of the STI. But if you notice, we are actually still quite near and comparable to the IHS REIT Leaders Index, which is at around 6.3. So you need to probably consider one thing. S REITs pay out roughly 90% of their distributable income as dividends and distribution. So they probably just have remaining 10%. But financials, especially banks, actually pay out roughly 50 to 60%. So they still are able to reinvest the next 40 to 50% of their retained earnings to fuel further growth. And that's where the income and also the growth element comes in. You still get 5% per annum in terms of quarterly distribution. But at the same time, because of the reinvestment of earnings, it's still possible to achieve further growth. And that is why the financial sector has also prospered throughout the centuries. But at the same time, being a traditional sector, it still pays consistent dividends. They are basically like dividend aristocrats. So because of this, it's an interesting finding we notice. 5.9% is more than enough to pay the 5%. We are much higher than STI, which consists of the 3 local banks, comparable to S REITs, which actually pay out a much higher percentage of their distributable income as dividends. And all these are happening because the growth catalysts are long-term and take time to be priced in. And another question some of you might ask is, US interest rates cuts might be coming. So how would this affect or impact APAC Financials? So remember I said earlier that the financial sector is an ecosystem with different businesses, and each different business actually has different interest rate sensitivity. So this is the important bit. Each business reacts differently to rate cuts. So even when, for example, there's interest rate cuts, like some of you might already be experiencing this. We have already seen headline news about savings accounts, interest rates being cut. So all these expectations actually could really drive more investment activity because investors now have to take more risk to generate a certain return. There's no more free lunch in terms of savings account interest rates. So all these actually could drive more investment activity, especially within APAC, by redirecting capital from the bank side, the banking side, towards wealth management and insurance businesses and insurance products. And that's where the growth potentially could come in. And if you're a bank, when interest rate is cut, you actually pay less deposit rates. Your funding costs, your liabilities actually get reduced. So that's also another point. And the third thing is that there's geographical diversification achieved through the ETF. Because if later I will explain even further, the ETF is a mix of roughly 6 to 8 countries in terms of constituents. So because of this, there's actually a huge mix of different countries at different stages of the interest rate cycle. So it's important because, for example, in countries like Japan recently just removed negative interest rates, and they are looking to increase interest rates. So actually, in terms of what happened for the powering and improvement in net interest margins, could actually happen for the Japanese financials and benefit them, even when US rate cuts actually are impacting some other constituents. So all these kind of neutralize and balance out each other. And when US rate cuts happen right now, even if they happen right now, the banks are already protecting their net interest margins from lower rates by increasing positions into longer term fixed rate assets. For example, buying longer duration bonds, giving out longer term loans. One key example also is DBS. They really made a conscious decision to put 30 billion Sing dollars of their fixed rate assets in Q3 and Q4 to protect against lower interest rates. So to summarize, the financial sector is actually an ecosystem diversified across businesses that has different interest rate sensitivities. And because of all these diversification of business units, it is what that has helped the financial sector thrive, survive, and prosper throughout centuries. So after covering why financials, why APAC Financials, 3 key catalysts, now I'll dive deep into the ETF, which is the Lion-OCBC Securities APAC Financials Dividend Plus ETF. And key thing, it is the world's first APAC Financials ETF. And it tracks the IH APAC Financials Dividend Plus Index, which then tracks the top 30 largest and most tradable APAC financials. And this is designed to provide stable dividends, but also at the same time potential growth within the financial sector. So it includes countries like Australia, Hong Kong, Japan, Singapore, Korea, Indonesia, Malaysia, and Thailand. And follows a 3-step construction process to be able to build the portfolio. So the first step is about index criteria, where the eligible sectors, for example, include banking, insurance, investment services. And the last one is what I would say makes it future-proof: specialty finance and services. So under specialty finance and services is where actually the digital banks, for example, like Grab, they're actually classified under right now. So by including all these inside, if one day these digital banks grow big enough in terms of market cap or become dividend yielding cash cows, they could be included into the index. So this is the element that makes the index future-proof. But at the same time, consistently allowing it to pay 5% per annum in terms of distribution. And another thing in terms of the index criteria would be the fact that it is shortlist constituents based on a 2-year average dividend yield. So key thing is 2 years, because we try not to use constituents that they only pay extraordinarily high dividend yield within 1 year. So we are looking at 2 years in terms of the criteria, in terms of dividend yield. And the next step will be under index selection and weighting. So free float market cap criteria is $1 billion. And there are 3 weightage caps to take note of. These are actually important weightage caps, which I will explain even later. 7% in terms of our single stock weightage cap, so it's to ensure diversification across stocks. 20% country weightage cap. So this is to ensure and limit country exposure, but at the same time still allowing you to gain access to high dividend yields. I'll share this example later. And also a 5% cap for Indonesia. And what you will end up in the end will be a portfolio of 30 APAC Financials constituents, weighted based on free float market cap. And the index will be balanced every 6 months, in March and in September. And there are 3 key features I want you to remember about this ETF, nicely summarized into FIG. Easy to remember. Focus on income and growth. So focus on income and growth. Focus on the top 30 largest tradable financial institutions within APAC. Income, 5% per annum quarterly distribution. Growth, potential capital appreciation in the APAC financial sector. In terms of the index performance, the index was launched back in 2nd of February 2024. And since then, within the past 2 months, until 31st March, it's actually achieved an 8% return. So if you compare to the STI, it's at 1.9%. So this distance is actually at around 6%. We outperform STI by 6% in the short 2 months. And if you compare to the IHS REIT Leaders Index, which is at negative 3.3%, we actually outperform this S-REIT Leaders Index by 11% in the past 2 months. And so because of this, it has outperformed comparable indices since its inception in the 2nd of February. In terms of index characteristics, you will see a colorful mix of countries here: Japan, Australia, Singapore, Hong Kong, Korea, and also Malaysia. And what you get is a financial sector portfolio that's diversified across APAC. And if we zoom in into the different constituents, you'll notice that the top 3 constituents are the 3 local banks, Singapore local banks. And after that, in the top 10, top 15, you will see there are mixed. There's Japanese banks, which could benefit from future rate hikes. There are Korean banks, which are actually very highly underinvested because a lot of people, like a lot of normal investors, including myself included, don't understand Korean. So because of that, we do not really have the linguistic capability to analyze Korean financials. You also see the Australian banks, the big 4 Australian banks are inside. You also see Public Bank, which is a Malaysian bank, relatively well known within Malaysia, one of the largest. And you also see different Chinese banks inside, the Hong Kong listed shares of the Chinese banks. And with all this happening right now within China, Chinese banks are actually paying 8 to 9% in terms of dividend yield. 8 to 9%. And a lot of Chinese banks are actually state-owned. So because of this, the default risk isn't that high for Chinese banks. But at the same time, the country exposure, because of the country weightage cap, is actually capped at 20%. So because of this, you actually get a so because of this, you can see that, okay, although the Chinese banks are much larger in terms of market cap, there are many more bigger and larger Chinese banks and larger number. So for example, you already see the big 4 Chinese banks, ICBC, BOC, ABC. And also at the same time, one of the top 6 banks within China, China Merchants Bank, also inside. So there are a lot of different Chinese financial constituents. They pay high dividends. But because of the country weightage cap, the entire China exposure is capped at only 20%. They pay high dividends, but this exposure is capped. So you get access to the high dividend yields, but at the same time, geographically diversify across beyond Singapore. You get diversification to Australia, to Japan, and also to other countries like Malaysia and Korea. So this is what makes this ETF interesting and beneficial for investors. You gain the benefit of geographical diversification, but at the same time, you diversify beyond Singapore banks and get stable dividends. So I'll talk about 2 key constituents right now. One is an Australian bank and another will be a Korean financial. So the first constituent I'll discuss will be about National Australia Bank. So it has delivered extremely strong performance. Cash earnings up 8%, around 8+%. The underlying profit was up around 16%. And it's actually Australia's top business lender in 2023, with around 22% in terms of market share. And because of this, you will notice that from January 2023 until 31 March 2024, the share price actually went up by 25%, excluding dividends. 25% within 15 months, excluding dividends. And this is also a case study example about capital light and digital business models. So for example, for its core business and private banking unit that focuses on SME customers, the profits actually grew around 22%. And this was attributed by the CEO in the annual report to be due to digitalization of account openings. They actually contributed 50% in terms of growth in new account openings since 2020. So because of this, you will notice that digitalization and capital light is the trend, is the catalyst, catalyzing growth and also at the same time, share price growth. So this is about National Australia Bank. Next constituent will be about KB Financial Group. Similarly, it is an interesting constituent. It achieved record high in terms of gross operating profit last year, with earnings up around 18% year on year, announced by the group CFO. And it's an interesting constituent in an under-invested market. It's a hidden gem. I will share more later. So KB Financial actually has 2 insurance arms. There's its own KB Life insurance arm, and also recently acquired Prudential Financial's Korean insurance arm for around $2 billion. And this merger was effective on January 2023. And since then, in January 2023 to March 31st, 2024, in the last 15 months, excluding dividends, the share price actually grew by 50%, 50% in 15 months. And and it's because actually Korean financials, they are underinvested. Not a lot of people outside Korea know about Korea financials. They are hidden gems. People don't really know much about them. But through an ETF, you gain access to the hidden gems across different countries and different regions. And that's what helps investors achieve geographical diversification. And in terms of KB Financial, they also grew a net profit at around 8+% in the past 4 years. And also the capitalization ratio has been also significantly above the Basel III requirement. They are at 13.6%, which is way higher than the Basel III requirement of 6%. And remember, I mentioned in the first catalyst that well-capitalized banks are more likely to maintain profitability. So this is another example where it's underinvested, a hidden gem, but at the same time still well-capitalized and able to grow net profit consistently. And because it's underinvested, not a lot of people know Korean or are able to analyze Korean financials. They do not look at it. But through an ETF, you get to include all these within the portfolio, but at the same time earn stable dividends and also get the upside potential from potential growth within APAC financial sector. So to summarize, the Lion-OCBC Securities APAC Financials Dividend Plus ETF helps investors in 3 key things. Focus on income and growth. Focus on the top 30 largest and most tradable APAC financials. Income, 5% per annum quarterly distribution. And growth, potential growth in the APAC financial sector. So the SGX ticker is amazingly simple to remember. It's YLD. It sounds like yield. If you can remember it, YLD, yield. Minimum payout in terms of first 2 years is 5%. And we hope you remember that 5% is a good yield. We hope you take the opportunity to earn stable dividends and invest in APAC financials today. Thank you, everyone, and I'll pass time back to Joseph.
Yep, thanks, Xun Xiang. All right, so right now we'll head over to the Q&A session. So if you have any questions, do send them over. Okay, so we'll answer some question. Okay, Xun Xiang got one question, right? They were asking, is that how do you compare this ETF with STI ETF, which also pay decent dividends with better diversification?
Okay, I think regarding this diversification, for STI, I think the difference is you are looking at sector diversification for STI because there's different sectors within STI. For example, like manufacturing, you have telcos and all these. But you also have noticed that STI is actually an index constructed quite long ago, back in the 1970s, 1980s. So whether it's still sector diversification, whether it's still achievable is one thing you have to think about. But through this ETF, what you get is actually geographical diversification for the financial sector. So it's something different. So even when there's like interest rate cuts or even interest rate hikes, different countries are at different stages of the interest rate cycle. And when a lot of people think about financial sector, they only think about banks. But actually, it is an ecosystem. It's not just about banks. There's investment management, there's stock exchanges, there's also insurance inside. All these business units react differently to interest rate cuts. And because of this, they are able to continue growing even if there are different changes within the macro environment. At the same time, what I can say is STI, they do not pay a minimum payout of minimum 5%. But this ETF, we will pay a minimum 5% per annum for quarterly distribution.
All right. So we move on to another question. Okay, I think one of the question is the 5% guaranteed and how do you ensure that?
Okay, in terms of the 5%, because right now, if you notice, right, in terms of I can share screen again. I think it's this one. The index dividend yield is already at 5.9% right now. And we are only targeting to pay 5% in the first few years. So this will be something that's achievable. And if there are any extra dividends received from the underlying constituents, we will just roll over to the next payment period to ensure that we can consistently pay out the 5%. So I mean, we have done backtesting for more than 10 years to ensure that we are able to pay out this 5% in terms of dividend. And if one day, let's say, really there's no choice, for example, if our index dividend yield maybe one day is just at 4.9%, we still have the option to be able to pay from capital gains to be able to meet the target payout of 5%.
Okay, Xun Xiang, adding on to the question, right? I think some of them was asking, will the dividend yield of the 5% be only for 2 years, and after that, what will happen?
Okay, for the first 2 years, we will definitely pay 5%. We will pay at least 5% because based on the different underlying constituents, the dividends received will be slightly sufficient. After that, true enough, I mean, when there's rate cuts, I mean, some of the interest rates or in terms of dividend yield could be cut. But even if it's cut, we are still able to pay from capital gains. And that's the thing about and the promise of the product, because we want to make it income product with sustainable passive income stream. So because of that, even we have to pay from capital gains, we will pay from capital gains. But as much as possible, based on the current environment, at least in the first 2 years, we will be able to pay out from the underlying dividends received from the constituents.
All right.
Okay, I think there's one question about ETF does not invest in Indonesia and Thailand. Okay, regarding this, right now, the index universe includes Indonesia and Thailand. It's just that in the recent March semi-annual rebalance, it is not inside. But it doesn't mean in the future semi-annual rebalances, it might not be inside. It's just that it wasn't inside for the latest rebalance. And what the index looks at is also at with different criteria in terms of dividend yield, for example, 2-year average, in terms of dividend yield, market cap, and also country weightage cap. So because of this, if the underlying constituents or the shortlisted constituents eventually pay high enough in terms of dividend yield for 2 years, in terms of average, we will still eventually include them. It's just right now, they haven't met the full criteria yet, so that's why they are not inside. But they will eventually be included if they can meet the criteria. Okay.
All right. Xun Xiang, we actually have one question from Tiger Life. Okay, so I think one of the question is, with interest rate cutting, bank stock price are likely to draw back and stabilize. Is that true? And if so, what happened to the dividends as well? And does it affect this ETF in any way?
Okay, I think the key thing to note that is the fact that the financial sector is an ecosystem. It's not just about banks. So even if the bank side, they suddenly, in terms of profits, they do not earn so much, the other business units are still able to complement and help the bank diversify in terms of the profit and income sources. And to the banks, actually, interest rate cuts are not really that bad because it reduces their liability, reduces their funding costs. So it means they actually pay less deposit rates. Their liability actually is decreased. So in the end, it's actually how they are able to, once their liability is decreased, they will redirect more capital to wealth management, to grow insurance, and there will also be more demand for wealth management and insurance products to be able to, and investment products to build for investors to be able to grow their rate of return. So actually, all these are an ecosystem because different business units react differently to interest rate cuts. And all these could help the entire financial conglomerate and the entire financial sector because of this diversification across businesses with different interest rate sensitivities. So this is the first point. Second point is also about geographical diversification because the ETF actually has constituents listed across different countries. So for example, you think about China, they have been cutting interest rates a few years ago. So because of this, they are at a actually very different interest rate cycle compared to the US, which is about to start cutting interest rates. But compared to China, they have really been cutting. And if we look on the other side compared to Japan, Japan recently scrapped the negative interest rate policy, and they are expected to increase interest rates probably in the second half of the year. So I mean, when they further increase interest rates, these actually will help to power the improvement in net interest margins for a lot of the Japanese banks. So that's the beauty of having different countries geographically diversified within the same portfolio. And also within the portfolio, the different constituents also are big enough because they are the largest and most tradable APAC financial institutions. So they have different businesses with different sensitivities to interest rate cuts.
All right. And okay, so maybe we'll take in the last, maybe 2 or 3 questions. All right. So I think there's one question is how do we subscribe to this ETF? No worries, I will share in a bit on how you can subscribe to this ETF during the IOP period on our Tiger Trade app. Okay. So meanwhile, let's just tackle 2 or 3 more questions. Xun Xiang, I think one of the question was asking about the Singapore banks. You want to answer that?
In terms of Singapore banks, how do we mitigate the FX risk considering that the Sing dollar right now is stronger than... Okay, in terms of to be upfront, we do not hedge currency. We are not hedging currency for this ETF. But it also, okay, so I think the fear is that, what if the other APAC currency suddenly strengthen so that there could be negative currency returns for the ETF. But I think the broader thing is to look at is also after the ETF is listed, there can actually be creations and redemptions happening for the units. So actually, if the creations and redemptions they happen on a periodic cycle, actually we will be buying at different prices and also at the same time buying at different currency rates. So all these will help to naturally balance. The currency impact actually isn't going to be that big compared to what a lot of investors might think. And second, I think in terms of the Sing dollar consistently is also expected to remain quite strong to be able to tackle imported inflation. And that's been the stance we have seen in terms of monetary policy in terms of the past few decades to be able to tackle inflation. Because Singapore, we are a small island. Our main aim is more to make sure import costs are low. So because of this, the Sing dollar is expected to constantly remain strong. And even if the other currencies appear to strengthen, there will be further mitigation measures to ensure that the currency impact won't be that big.
All right. Okay. So maybe Xun Xiang, you want to take the last question? Maybe you can choose from the Q&A session.
Actually, there's the question about 5% dividend per annum. Will the ETF price be dropping? So actually, we will be the thing is okay. For example, maybe one day, if the ETF actually increases from after listing, maybe increases to 1.05, because we will actually pay 0.05 in terms of what we see from the ETF. And so regardless whenever there's a dividend payment, even if it's for a normal stock, there will be this deduction from the net asset value. Even if you buy DBS, OCBC is the same. They will, when there's this dividend payment, it will just gets reduced from the share price. So actually, what the attendee mentioned is correct. I mean, the ETF price will be dropping, but it's actually the same treatment if you buy any other stock or any other equity instrument.
All right. Xun Xiang, I think we will pause right here on the Q&A session. Okay, so what I'll do right now is that I'll showcase on how you can subscribe to this ETF during the IOP period, okay, on our Tiger Trade app. Okay, so let me just quickly share screen. Okay, I hope you can see my screen. Okay, so first off, let's recap. Okay, the name of the counter, right, for this will be the Lion-OCBC APAC Financials Dividend Plus ETF. Okay, the listing price will be $1. And currently we are promoting the SGD currency. Okay, so this IOP period, the initial offering period, is live right now all the way until 2nd of May, 5 p.m. on our Tiger Trade app. Okay, so I repeat again, this ETF IOP period is live right now all the way until 2nd May, 5 p.m. You can subscribe on our Tiger Trade app. So how to subscribe, okay, to our ETF is that you can go to the Tiger Trade app. Okay, on the app itself, you will see this portfolio icon right here on the first screenshot, and you will see IPO. Okay, you click on it and you click on SG Market. Okay, the first ETF IOP is Lion-OCBC Securities APAC. Okay, this is the one, and you click on subscribe. Okay, right here you can see how much you want to subscribe to. Okay, the minimum subscription on the platform itself is minimum 1,000 units in multiple of 100 units. Okay, so the listing price is $1. Okay, so the subscription quality is minimum 1,000 units in a multiple of 100 units. Okay, so let's say if you subscribe to maybe 1,000, 50,000, or 100,000 and so on. Okay, the allocation is 100%. It means that if you subscribe to 1,000 units, you'll be allocated to 1,000 units. You subscribe to 50 or 100,000 units and so on, you will be allocated that amount as well. Okay, there is no subscription fee on our platform. Okay, there is no subscription fee on our platform. Right here, you can subscribe this ETF IOP on our Tiger Trade app. Okay, so I hope that's clear for the users who left a comment in the chat. Okay, so yep, Xun Xiang, you have anything to add on before we end the session?
Okay. First, I think what Joseph showed is actually a very simple and also smooth experience to subscribe for the ETF on the Tiger Brokers app. So it's like a three-step process from how I see from Joseph's screen here. So it's actually what you will gain when you use Tiger Brokers app to subscribe for the ETF. And in terms of final key messages, remember the ETF helps investors like you and me focus on income and growth. Focus on top 30, 5% per annum quarterly distribution, and also potential growth in the APAC financial sector. The SGX ticker is easy to remember. YLD, and remember YLD and 5% per annum for quarterly distribution.